Good day, everyone, and welcome to today's Citizens Bank Global Markets webcast titled Interest Rates, Markets, Themes, and Strategies. This webcast will be 30 minutes long and is being recorded, so everyone will be in listen-only mode. At this time, it is my pleasure to introduce today's speaker. From Citizens Interest Rate Products team is Managing Director Matthew Risicato. For over 25 years, Matthew has worked with CFOs, treasurers, and controllers in designing and implementing interest rate hedging programs. Matthew started his career in Salomon Brothers and graduated from Fordham University in New York. Now, without further ado, please let me welcome Matthew Risicato. Hey, Matt, take it away.
Hey, good morning, Patrick, and thank you. Good morning, everyone. We'd like to thank you for joining us today. Hopefully, by the end of this brief 30-minute presentation, we'll have answered many of your questions about the current rate environment, the hedging strategies we've seen many of our clients explore and execute, and perhaps provide some guidance as to what rates in the future might look like. Over the past 6 months, we have seen a global economic upheaval unparalleled in modern times, one that was not caused by a financial event, such as the 2008 bursting of asset bubbles, but rather a voluntary shutdown of the world's economies to stem the spread of a global pandemic. The result has been a massive flight to safety, with rates falling to historic lows as an unprecedented amount of both fiscal and monetary stimulus floods the markets to combat the negative effects of the pandemic. While the symptoms of this financial crisis are similar to those in the past, in this recession, it is very difficult to view history as a good predictor of the future, as the causes of this slowdown differ dramatically from its predecessors. While yet to be determined, the economic aftermath and the trajectory of rates will be the focus of our discussion today. In short, as we will illustrate, we expect the economy to begin to recover from its government-imposed lockdown in Q4 or early 2021. Its trajectory, however, while still very much undecided, does provide many opportunities given current market conditions to consider transacting interest rate risk management solutions. Most importantly, we view the greatest risk for our clients is a recovery for whose pace and trajectory is greater than what the market is currently predicting. So we wanted to start off by illustrating just how far long-term rates have declined. So on the next slide, we have a graph of the 5-year U.S. Treasury going back to 1995. A quick look at the graph shows that the long-term trend has certainly been for a decline in rates. In fact, if we go as far back as 1980, the trend is longer and steeper, as the 5-year U.S. Treasury at that point in time eclipsed 16%. So in essence, what we have experienced since 1980 is a bull bond market with rates plummeting from all-time highs to what are today all-time lows. As we narrow our focus to recent events, we illustrate with the green arrow on the lower right-hand part of the graph. Beginning in December of 2018, we saw a large decline in rates, with the 5-year U.S. Treasury rate declining over 275 basis points as a string of geopolitical risks weighed on the economic outlook. Now, more specifically, a brief timeline demonstrates that in November of 2018, we began with the 5-year U.S. Treasury trading at 3.09%. December 2018, brought a temporary government shutdown. 5-year traded at 258. In March of 2019, with the China trade war speculation and some weak corporate earnings, the 5-year declined further to 2.21%. And then in May of 2019, with Brexit concerns, we hit a rate of 1.86%. That said, however, most of the 275 basis point decline occurred in an even shorter span that we have highlighted in the 2 gray ovals shown. This occurred during the most recent 6-month period between Jan 2020 and early June of 2020, as the pandemic took hold and spread globally, whereby the 5-year Treasury fell 150 basis points, ultimately reaching its historic low of 30 basis points at the end of May. We stand today just shy of that level at around 32 basis points. Continuing with our illustration on this slide, if you look at the table below, we show the Fed funds rate, 3-month LIBOR, 2-year, 5-year, and 10-year U.S. Treasury rates. What is notable is that all of these rates are now significantly below the post-2008 crash. interestingly enough, is that while the Fed's target rate from the post-2008 crash and today's Fed target are virtually the same, anchored near zero at 12.5 basis points, longer-term rates are lower today than they were in 2008. So just a quick glance at these. Just looking at 3-month LIBOR post-2008 crash, it was at 1.19%. Current conditions, it's at 0.3%. The 5-year U.S. Treasury post-2008, 1.66%, and currently 0.33%. And then finally, going out even longer on the curve, you see the post-2008 10-year yield at 2.66% and currently at 0.71%. So the question becomes, why the difference in outlook between 2008 and today? We believe the answer lies in the expectations the bond market has for the timetable of an economic turnaround. As we will show in the upcoming slides, market pricing reflects the expectation that it will take better part of 10 years for the economy just to begin to retrace to levels last seen in December of 2019. And this illustrates the point we will make over the next couple of slides, and that is the market is truly pricing in a potential worst-case scenario for the U.S. economy, whereby the economic destruction being wrought by the coronavirus is anticipated to be greater than that of the 2008 Great Recession. So we believe at this point, this view is overly pessimistic, and that brings us to the potential recovery shapes we see on the next slide. Now I'm sure everyone has seen these. If you're watching the news, these have been widely proffered up. This slide offers a history of the 4 economic recoveries being most widely discussed: the L, the W, the U, and the V. Now the L shape, this scenario is characterized by a severe economic recession where growth does not recover for many years and inflation remains stubbornly low. In 1990, to use an example here, Japan experienced an L-shaped recession which lasted a better part of that decade, frequently deemed the lost decade for Japan. The remaining 3 scenarios are optimistic in that they all anticipate some type of economic rebound in the near future. The W shape, also known as a double dip, this is exactly what it looks like. It's a V-shaped recession and recovery, followed by another V-shaped recession and recovery. If we were to apply this to our current situation, this might occur if, say, we relax the coronavirus containment measures prematurely, saw an improvement in the economy, and then it fell victim to another another outbreak, forcing another shutdown. The period from 1980 to 1982 is considered to be a W-shaped recovery. The next shape is the U-shape, means that after our economy falls off a cliff, like the V, but then eventually slowly climbs back to normal. The recession of 2008 is an example of the U, where GDP shrank for several quarters with growth slowly climbing back to previous levels over a span of 2.5 years or so. Again, if we were to attempt to apply this to our current economic environment, with the U-shaped recovery, we can expect economic hardship to persist until at least late 2020 and likely into 2021, but we can take comfort in the fact that an upswing will come. The V-shaped recovery, the final recovery, is marked by a steep, dramatic decline in the economy in the first half of the V, something we've just experienced, similar to the first half of 6 months of 2020, followed by an equally rapid upturn, mirroring the preceding drop in speed and intensity, which is the second half of the V. Now, this is the best case scenario, constituting a strong recovery and one the U.S. economy experienced in 1953. Now, all this leads us to the next slide, is what is current market pricing telling us about the recovery? Okay, on the slide before you, titled L-shaped recovery, we use the futures market for Fed funds, 3-month LIBOR, as well as the 5-year forward 5-year swap rate to show that the market's expectation is for an L-shaped recovery that is characterized by very low rates and extremely flat yield curve. For the Fed funds, which is the first graph on the left, we show market pricing for future policy action is pessimistic over the prospects for a near-term recovery, in that it does not return to a pre-COVID-19 level throughout 2022, essentially anticipating a near zero Fed funds rate for most of the time with a high of only 10 basis points. An interesting anecdote here is many of our clients have been inquiring about what the likelihood is of a negative rate policy. While the market could theoretically price in negative forward rates, we remain skeptical of this outcome, given the Fed's very vocal position against a formal negative rate policy. This is also supported by the fact that at its last meeting, not a single Fed member submitted a negative Fed funds forecast. So taking a look at the second graph on the right, on this slide, we have 3-month LIBOR futures. Similarly, the forecast for 3-month LIBOR is equally pessimistic, with the futures market showing a flat to a very slow but gradual increase, with LIBOR forecasted to reach only 88 basis points by December 2025. You see that blue line right in the middle, and only 1.5% by 2030. Now, keep in mind, today, 3-month LIBOR set at just over 28 basis points, but as recently as March 3rd, only 4 months ago, it was at basically 1.5%. Finally, we show the expectation for future term rates with the final graph on the far right, which shows that the 5-year swap in 5 years is anticipated to trade at just under 1% at about 98, 99 basis points. Again, as recently as March of this year, the 5-year swap, spot swap, was trading at 1%. So in short, what we're attempting to illustrate here is that current market pricing reflects the expectation that it will take a better part of 10 years just to return to the levels that we've seen only earlier this year. All right, if we go to the next slide, the market's historical bias. Okay. Earlier, we had made mention of how the economic destruction being wrought by the coronavirus is anticipated to be greater than that of the 2008 recession. Here we show on this slide what we believe the market is basing its L-shaped recovery on, and that is its historical bias, looking at the past to predict the future. We say that because the only U.S. economic downturn of similar magnitude to happen in the post-World War II era was the Great Recession of 2008, where the Fed similarly brought its base rate down to near zero. So a quick look at the graph on the left, lower left, shows the unemployment rate and how it took almost 10 years for the U.S. economy to recoup all the job losses incurred. Similarly, a look at the Fed funds rate on the graph on the right. It took the Fed a full 8 years to begin raising rates in 2016, then taking an additional 2 years for the Fed to raise rates high enough to get back to pre-crisis levels. And even then, the growth was less than robust, with inflation, as we all remember, virtually non-existent in 2019. So given this background, where does that leave us today? As we mentioned at the outset, with current market pricing in an L-shaped recovery, we feel the biggest risk for our clients is a recovery whose pace and trajectory is greater than what the market is currently priced, than what current market pricing is currently reflecting. We maintain that it is possible that the most likely form of recovery going forward is in one form or another, one of the 3 more optimistic outcomes outlined earlier, the U, the V, or the W. So in fact, if we look at the performance of the equity markets, the recovery shape is more of a V at this time. And we illustrate this on our next slide. Here, what is interesting to note is that you see there is a great divergence in expectations between the bond and equity markets. With equities, the S&P 500, using the green line, rallying, and rates, the 5-year U.S. Treasury blue line, falling. This also happened to occur in 2008, and it was then a good indicator of the economic turnaround. You see, beginning in late 2009, it took the broader S&P 500 almost 3 years to fully recoup the losses that incurred that began with the collapse of Lehman Brothers in September of that year. After that, rates began to rise as the economy improved and continued its ascent along with equities through early 2019. Conversely, today, looking at the shaded area on the far right, the sell-off in equities that began in late February has almost been completely erased after just 4 months, suggesting the downturn may not be as significant as initially expected, leading us to focus more on a V-shaped outcome. Given this divergence in expectations, we argue that clients should be opportunistic in order to take advantage of an historically low rate environment and flat yield curve, as it offers significant opportunities to establishing rate certainty not only today, but in the future as well. So how can this be accomplished? So what we have outlined for you on the next several slides are what we believe are viable strategies to take advantage of the current rate environment, many which we have seen our clients transact over the last several months. Here again, because of the historically low rate environment flat yield curve, clients are both extending duration when they can and increasing the amount of fixed rate debt in their capital structure. So let's go to the next slide. All right, so Extending duration. This is the first opportunity. This applies for any client that will always have some form of bank debt, whether it's a revolver or term loan. Here, clients are extending the term of their hedge solutions, in many instances beyond the maturity of their existing credit facilities. For example, let's use a client has a core amount of debt outstanding. The debt historically has been refinanced every 5 years and has 3 years remaining. Here, a client can execute today a new 5-year swap or longer instead of a 3-year hedge, in a sense hedging beyond the maturity of the existing financing. Now, the rate premium to execute a 5-year hedge versus a 3-year hedge is at an historically low differential of only 10 basis points. Beyond extending duration, what we've seen clients doing as well is increasing their fixed to float ratios. Here we have seen a particularly large increase in activity for clients that were running a more neutral 50-50 split. Many are now much more heavily weighted toward fixed, moving up to 70% fixed, 30% floating, and some even higher. The benefits of these strategies is that it enables clients to create long-term rate certainty for financial budgeting and lessen the potential impact interest expense volatility may have on financial statements. We do address this impact a little later in the presentation when we review the possible interest expense savings that would result if we saw rates to retrace back to pre-COVID-19 levels. The next set of strategies to focus on are anticipatory hedges on the next slide. All right, here we have securing interest rate certainty to hedge future new or maturing obligations by using forward starting strategies. Now, given the current term structure of interest rates outlined previously, clients have been particularly active executing forward starting strategies that are effective typically 1, 2, and even 3 years in the future, that are designed to address on a preemptive basis 3 situations. One is maturing floating rate debt or fixed rate debt, where the facility is expected to be refinanced, maturing interest rate hedges that are anticipated to be rolled on the respective future maturity date, and new anticipated debt. All are candidates for a forward starting hedge that can be transacted today, mitigating the interest rate risk incurred by waiting to their respective maturities. An example, client has several hedges expiring in 1 year. The client also anticipates having bank debt outstanding at that time that would revert to floating when these hedges mature. The client is concerned about rates rising in the interim and would like to lock in a fixed rate for another 5 years to hedge the rollover risk of its existing hedges. What the client can execute today is a 1-year forward starting 5-year interest rate swap that would become effective when the existing hedges expire. Given the flat curve, the strategy is very attractive given how little premium it costs to execute a swap on a forward basis. In this case, if you're comparing the 1-year forward to a 1-year forward 5-year to a swap that starts today, that's a 5-year swap that starts today, the premium is only 9 basis points. All right, now if we go to the next set of strategies. The next set of strategies focuses on interest expense relief solutions. Here we are showing 4 solutions that could lower interest expense over the near term while still providing long-term protection. The first one is a step-up hedge. A step-up hedge offers a below-market coupon for the early years that steps up gradually over the course of the hedge. The average rate over the term of the swap is identical to that of the single coupon vanilla swap for the same term, and therefore the client would be economically indifferent. For example, as illustrated on this slide, if the 5-year single coupon vanilla swap was trading at 75 basis points, a step-up structure could look something like this, where year 1, the client pays 25 basis points, year 2, 50 basis points, year 3, 75 basis points, year 4, 1%, and then year 5, 1.25%. Now, this offers a significant interest expense savings over the first 2 years of the hedge, given the below market coupons. Ultimately, it is paid back with the above market coupons scheduled for years 4 and 5. Now, keep in mind, this can be structured or modified to meet a client's particular needs. For clients maybe whose businesses are very cyclical in nature, the rate can be structured to be lower in order to have a lower cost base when revenues are lower and a higher cost base when revenues are higher. So all of these, all these structures are very, can be structured to meet customers' needs. The next one, callable cancelable swap strategy whereby the client pays a below market coupon over an initial predetermined period in exchange for selling citizens the right to call the swap on a specified date in the future. The sale of the option creates value that in turn lowers the swap rate. Now, here in the illustration, we are showing a 10-year swap where Citizens has the right to call the swap one time at the end of the 5th year. The result is a savings over the vanilla swap of approximately 30 basis points per annum to the call date. That said, the client does run the risk the swap is called on the call date when rates are higher. On the next slide, please. We're continuing with these strategies. Swaps with partial term floors. With the decline in LIBOR, in order to guarantee banks a minimum return on an asset, what has become very commonplace in new credit agreements is the presence of LIBOR floors. What this does for banks is that it guarantees them a minimum return even if LIBOR continues to stay low. The bad thing is that it affects customers negatively in the sense that, for example, if a client has just closed on a new 5-year facility that has a 1% LIBOR floor, with 1 month LIBOR at 19 basis points, the client is still obligated to pay 1%, and through its life would never pay less than 1%, no matter how low LIBOR goes. So an interest expense saving strategy to offset this effect is a 5-year swap whereby the client purchases a 2.5-year floor to offset the floor under their credit agreement. The cost of this floor is embedded into the swap rate. The result, however, is a swap rate that is actually below the rate of the floor, typically 20 to 25 basis points lower, thereby reducing interest expense for the initial 2.5-year period. For those clients who are worried about hedge accounting, usually public companies, this should qualify for hedge accounting, although we do suggest that you check with your auditors. One other, and I believe final hedge opportunity is the blend and extend. This is accomplished by restructuring existing hedges by adding notional or extending tenor. This has become increasingly popular as rates have headed lower and lower, and enables clients to lower existing coupons to achieve immediate interest expense relief. For example, a client has 3 years remaining on their swap and carries now what is an above market rate of 2.5%. Consequently, there's also a large termination fee. Under this strategy, the client could terminate their existing hedge, blend the breakage cost into the rate of a new 5-year swap, and still achieve a 50 to 75 basis point reduction in rate while extending the duration of their protection by as much as 2 years. So just to put some numbers on what we feel the potential shape, the potential benefit is if the recovery is something other than L-shaped. On our final slide, we have shown 3 potential rate paths of the potential interest rate savings over a 5 and 10-year period if a hedge were executed at today's levels versus a hedge executed in a potentially higher rate environment that would occur in a V, U, or W-shaped recovery. So if we go to the next slide, Patrick. Thank you. That's the interest expense analysis slide. So here you see the green line that represents the interest expense incurred if a hedge were executed today at current levels. So here you can lock in interest expense over a 10-year period per 10 million, and the interest expense would be 352K, represented by the green line. However, if a V, U, or W recovery does occur, a hedge executed today will result in significant interest expense savings, given a 50 or 100% return to the pre-COVID levels illustrated earlier. So given a 50% retracement back to pre-COVID levels, and which would only imply a 68 basis point increase from today's levels, so not very far off from where we are today for a 50% retracement, represented by the light blue line, the savings would amount to over $500,000, about $525,000. The even higher savings of almost 1.1 million would be realized if 100% retracement to pre-COVID levels occurred, as illustrated by the dark blue line. Part of our conclusion here, and I hope this was brought across clearly, is that we maintain that there is value in the forward curve, regardless essentially of the shape of the recovery. It's especially so, though, if the outcome is ultimately something other than the L shape that current market pricing reflects. So at this point, I am going to wrap up our discussion. I do want to thank everyone for their time today. Hopefully, we were able to bring some clarity to the ongoing situation, perhaps provide a healthy dose of some much needed optimism, and provide some actionable strategies that could be employed to help your businesses today and in the future. To that end, we ask that you reach out to your bank or interest rate derivative representative to discuss your options in further detail. And I believe on the last page, we did provide a list of the IRD contacts. So a little past 25 on the hour. Again, I wanted to thank everyone for their time today.
Thank you, Matt. And ladies and gentlemen, this concludes today's webcast. The replay link of today's presentation will be sent to all registered participants. If you have any questions or would like to speak further on this topic, like Matt said, please contact your Citizens Bank or interest rate representative. If you enjoyed today's session and found it to be helpful, please stay tuned for upcoming Citizens Bank events. Thank you and have a great day.